The emphasis on expectations was reforming economists' views on the business cycle. Keynes had said that wages were sticky, and it was nothing but stubbornness that they didn't change. But the monetarists had suggested that the stickiness was really due to a mismatch between expected inflation and actual inflation. When the economy is functioning normally and at full employment, competition between firms ensures that labor markets set fair wages for workers, and everyone who wants a job, anyone participating in the labor force, will get one. But as time goes on, firms have to make judgments about future inflation so that they can stay competitive. They set their expectations for inflation and make adjustments to their employees' salaries. Again, it's competition between firms that drives this. If one firm is giving cost of living raises, other firms need to match in order to attract and retain employees. But let's say that inflation outpaces those expectations. In this case, the firms have cause for celebration. They raise salaries to stay competitive, but it turns out that the raise was smaller than it should have been. Firms are seeing higher revenues due to inflation, but their labor costs are lower than they should be. With a better profit margin, firms opt to strike while the iron is hot and hire a few more workers at these bargain wages and overproduce. This is an economic boom where the economy burns through resources too quickly. But then we go through another round of the expectations game. Firms reset their expectations and have to adjust salaries to match. Let's say that this time they overshoot inflation, which ends up being way lower than expected. Now firms are in a panic. Revenues are way down as prices fall or fail to rise fast enough to meet obligations. To keep the bottom line from plunging into the red, these firms have to reduce their workforce significantly, laying people off because workers are just too expensive due to the oversized raises they gave based on their inflation expectations. Now the economy is in a terrible recession, and it won't recover until the Fed or other government policy reinflates the economy to support these wages. This is our monetarist model of the economy. But there was disagreement about how firms and everyone else would set their expectations. Early monetarists used adaptive expectations in their economic models. But a new group of economists, who would come to be called the New Classical School, thought that this was an absurd assumption and instead believed that people had rational expectations. It may sound innocuous, but these two assumptions have massively different conclusions about counter-cyclical policy. Here's what the proponents of rational expectations found so silly about adaptive expectations. We have this massive organization called the Federal Reserve, which has been endowed with incredible powers over the money supply and unlimited ability to control the rate of inflation, with a mandate to use those powers to do exactly that. And every time they have a meeting of the Federal Open Market Committee, the chair of the Fed comes out and tells everyone what they're going to do in a press conference, which is covered by every news organization in the country. The assumption of adaptive expectations believes that everyone simply ignores them and chooses to believe inflation will just continue with whatever it was most recently. Rational expectations doesn't assume people have magic abilities when it comes to forecasting inflation. This new classical school suggests that people will almost always get it wrong, but they assume that the people will take into account all the information available. And so if the Federal Reserve says they're targeting 2% inflation, then people will take that into account. And if the Fed is credible in their claim, meaning that they usually deliver on their promises and hit their targets, as they often do, then inflation will never really differ from expectations. And so monetary policy will be baked into the system. This is both good news and bad news. It means that a transparent Federal Reserve, which credibly commits to its inflation target and consistently hits it, will be able to keep the economy stable. So long as inflation doesn't significantly deviate from expectations, things will be fine. But if something unexpected happens, as it will from time to time, the Federal Reserve will be powerless to help the economy, because anything they do will be taken into account and accommodated for. Only random and unpredictable deviations from expectations will have any real effects on the economy. Money might not be neutral, but monetary policy will be. The bad news for the Keynesian view did not end there. These new economists also brought expectations into their analysis of consumer behavior. They formed the permanent income hypothesis, which predicts that people will try and smooth out their consumption across their lifetime. There is still a lot of uncertainty in life, but some things are pretty predictable, and people will act in advance of them happening. This idea matches what we see in reality. When people are young, they tend to borrow money for things like school, cars, and houses. But as they get older, their incomes tend to increase while the spending stays about the same. They start saving a lot more, and eventually they retire, dropping their earnings to zero, but living off their savings and keeping consumption about the same. Rational people do this because it's a very rational thing to do. But this theory is incompatible with Keynesian economics. To keep things simple, let's just have income flat like this, and consumption smoothed out across it. During a recession, the Keynesians say the government should cut taxes and increase spending. Both policies are designed to increase people's incomes, but only temporarily. The permanent income hypothesis says that people will try to smooth out this additional income over their lifetime. So if a recession strikes and the government sends everyone a stimulus check in the mail, the new classical economists hypothesized that most would spend a little bit of it, but probably save the rest or use it to pay off some debts. Actual increases in consumption spending will be only a small fraction of the government spending. And it doesn't stop there. People will see through the government plan. They know the money is coming in today, but down the road, they will have to raise taxes to pay off the government debt. Expecting a tax increase that will reduce their income, people will just save the whole thing, and the government stimulus won't help the economy at all. Rational expectations suggested that Keynes's expenditure multiplier was very small, maybe even equal to 1, offering no magnification of government spending at all. The criticism that so badly undercut the idea that the government, with a Federal Reserve, was capable of managing the economy can be summed up as the cold fronts are listening. When a weatherman predicts the weather, the clouds don't conspire to prove him wrong. But when it comes to the economy, the people can see what policies are being implemented, and they can incorporate them into their decisions. Here's another analogy. Suppose government data says the typical American family buys 1 box of Cheerios each week. The Keynesian view is that the government could start a new program where they buy a box of Cheerios and send it to every household each week. Then the typical household will now have 2 boxes, boosting employment at Cheerios factories. The Lucas critique, laid down by the Nobel Prize winning economist Robert Lucas, was that the future does not look like the past, and people will respond to economic policies in advance. Reading about the new program and expecting a box of Cheerios to come from the government, households will simply reduce their Cheerio purchases by 1 box per week, and the typical household still gets 1 box per week in the end. The government can't boost our overall Cheerio consumption by buying us Cheerios, and they can't reduce unemployment that way either. From the Lucas critique, we get the policy ineffectiveness proposition, which argues that economic policy cannot systematically manage aggregate demand and thereby manage the levels of output and employment in the economy. Around the same time as the new classical school of thought was laying out these critiques and propositions, the economy was experiencing a kind of turbulence that defied the suppositions of the Keynesian view. An energy crisis brought about by spikes in oil prices, combined with continued high government spending, embroiled the economy in a bout of high inflation and high unemployment. The short-run trade-off between inflation and unemployment predicted by the Keynesian model was broken, and Keynesian theory was on the outs in the economics profession.